The ATO is not just looking for dodgy claims. They're looking for mismatches. They're looking for poor records. They're looking for transactions where the story in the tax return does not reflect the facts. For most people doing the right thing, this shouldn't be a drama. Tax time has rolled around for the 2026 financial year, and we need to consider what the ATO's focus is for this financial year. This is not going to be just about checking deductions. My view is that 2026 will be very much a data matching year. The ATO has information from banks, share registries, crypto platforms, rental platforms, employers, contractors, and overseas reporting systems. So the question is not just, did you lodge your tax return? The real question is, does your tax return match the data that the ATO already has? The first big area we need to consider is omitted income. This relates to crypto transactions, share sales, rental property income, share economy income, contractor income reported through TPAR, foreign income, and residency-related issues. In simple terms, if the money came in or an asset was sold, the ATO may already know about it. The second area of focus always is work-related expenses. The ATO will be looking at work-from-home claims, car expenses, uniforms and protective clothing, and large claims that don't match the taxpayer's occupation. The issue is not just whether or not the deduction feels reasonable. It's whether or not the taxpayer has the records to prove it. The third focus area are rental properties, and this really will be quite a major one. The ATO will be looking very closely at interest claims, including mixed purpose loans, repairs versus improvements, Airbnb and holiday rental income, private use, and capital gains where properties are sold. And this is where really strong record keeping matters. Loan statements, settlement documents, invoices, emails, notes, and timeline can make a huge difference. Another focus area for the ATO is going to be holiday homes and mixed-use properties that'll get some attention. If a property is rented out for part of the year, but also used privately, the deductions need to be properly apportioned. We can't claim all the costs because the property was available for rent. This is where people can get caught out. For business owners, trusts, and private companies, the focus will likely include Division 7A loans, business money used personally, trust distributions in the Section 100A, unpaid present entitlements, whether or not the paperwork actually matches what happened. This will be especially important for family groups and private company structures. Another area that the ATO will be focusing on, once again, is property development. The ATO is interested in whether or not a transaction is genuinely capital or should be taxed on the revenue account. And that's because the tax treatment and tax implications can be vastly different. Subdivisions, developments, GST, and the margin scheme are all likely to attract attention. So the practical takeaway is this. The ATO is not just looking for dodgy claims. They're looking for mismatches. They're looking for poor records. They're looking for transactions where the story in the tax return does not reflect the facts. For most people doing the right thing, this shouldn't be a drama, but you need the records. Make notes, keep timelines, save documents, keep your loan records. These are effectively documents that we want to prepare at the time and never have to refer to again. But on those odd occasions that we do, it's always comforting to send across to the ATO a full and complete copy of the file for their review. Then we can just let the ATO do their job and sleep easy at night.